Burger. Today in episode 366, we're going to talk about what else? Inflation, interest rates, and recession. Is there one? Do recessions exist anymore? Are they still a thing? I'm doing something a little bit different today, and it could go really wrong. It could go badly, but I've decided to live stream the podcast to the YouTube channel, the Dough Roller YouTube channel. When it's over, I'll take the audio and upload it to the podcasting service I use that then sends it out everywhere. So we'll see how this goes today. And it's one of those things where I have no feedback to know if things are going well or not in terms of the stream. So hopefully things are working. If not, I'll figure it out later. And can, of course, always download this podcast video and upload it, whether the live stream part of it works or not. And we'll see how it goes. So as you may know, some important inflation numbers were released this week, and I want to talk about them. I want to talk about them, first what happened, what are the numbers, want to look at how that affects interest rates, if at all, including mortgage rates, savings rates, bond yields, and then talk just a bit about the Fed and what the Fed is going to be doing, and why, and more generally, why aren't we in a recession? Because we're clearly not. And by the way, I see Steve joined the live show. So apparently you guys can actually see and hear me, which is good. So let's dive right in. By the way, if you're listening to this in the future as just the podcast, you might want to check out the YouTube video, because I'm going to be showing you a lot of things on my screen, but I'll be talking through them. And I'll link to everything, but both below the video and in the show notes of the podcast. So with that, let's get going. So what was it? Wednesday, I guess. The U.S. Bureau of Labor Statistics released their monthly CPI numbers, and I don't know what the market expected, but this was a surprise to me. Let me do this. There we go. For the 12 months ending in June, CPI came in at 3%. I mean, remember when it was significantly higher and it was like, this is going to be the 70s all over again. And of course, the Fed was raising rates. And we've just seen inflation come down, I think, very quickly, certainly faster than I expected. I mean, 3% is still, of course, higher than the Fed's goal of roughly 2%. But boy, I mean, we're at least in the right neighborhood, right? And in fact, on a month-to-month basis, prices only increased 0.2%. Now, if you just multiplied it by 12, which doesn't really quite work that way, but, you'd be at, we'll call it 2.5%. So this was a really good number, and the stock market has responded, with, the way it does, with the market up. So it's almost like, the roaring 20s, which I guess maybe is not a good comparison, but I do think it's important that we dive into this number, because if you just look at the top level 3%, CPI number over the past 12 months, I think it can be a little deceiving. But before we dive into the details, yesterday, the PPI, the producer price index, came out. It's basically flat. Now, so understand CPI is basically the inflation is measured what consumers pay, the prices you and I pay for food and housing and, cars and that sort of thing. The PPI is like, you can think of it as a wholesale inflation rate, what companies are paying. And it was only up 0.1% in June. And in fact, they break it down between goods and services. Goods were flat. Services were up 0.2. And they even say the prices for final demand advanced 0.1% for the 12 months ended in June. I mean, basically, at the wholesale level, there's no inflation. It doesn't exist. Which I do think bodes well for the CPI. The idea being that businesses don't have increased costs that they need to pass on to consumers. At least that's the theory, right? Having said that, there are some things where for consumers, prices are still going up much, much higher than we would want. And that's where we need to sort of dive into the CPI numbers a bit. So let's do that. This is a chart that they release as part of the CPI numbers. Again, this was for, they just released it, and it's for the June 23 numbers. And what they do is they break down the 3%, and they look at both for a unadjusted 12 months ending in June as well as month to month. They show you the numbers, and there's a couple of things that really stood out to me. The first is if you're watching the video, you'll see these numbers on the far right side. A big reason the top level number 3% has come down. It's come down from much higher numbers, is because the cost of energy has gone down significantly. In fact, over the 12 months ending in June, energy overall is down almost 17%. And like gasoline is down significantly, 26%. And so that drives a good part of the CPI number. It's one of the reasons, probably the biggest reason, that it's come down so much, which gives me a little bit of concern, only in the sense that, we know how oil prices can fluctuate, for example. I mean, yeah, gas prices are down and that's good, but boy, it seems like it wouldn't take much, some issue in the world or some decision by oil producing countries, in terms of output, that could send those numbers back up. So that's one big takeaway. The other thing that I noticed is that so energy's sort of causing inflation to push down. What's causing it to stay higher? Shelter is a big one. And if you look at shelter month over month, it was up 0.4, which is pretty significant. And for the 12 months, it was up almost 8%, 7.8%. And if you're trying to rent an apartment or buy a house, you experience this firsthand. Just from seeing things online, housing costs are a real problem for a lot of consumers. And I can speak from experience just with my own children and the housing prices that they pay. And one owns, one rents, and the numbers have just been crazy. And so, and keep in mind that shelter is a significant part of the CPI calculation, right? Not all these numbers are treated equally. Shelter is a significant part of the CPI number, just like it's a significant part of most people's budget, right? Sort of the same idea. And so that's actually been keeping prices up. But the other thing too is that, food is interesting. So for the 12 months ending in June, it's still up 5.7%, which is way too high. But when you look at the last 4 months, March, it was flat. April, it was flat. May, it was up 0.2. And June, it was up 0.1. Food prices generally have really moderated, unless you eat out. If you go to restaurants a lot, I got bad news for you. For the 12 months, it's up 7.7%. And in more recent months, it's not moderated at all. Just starting in January, it was up 0.6, and then 0.6, 0.6, 0.4 in April, 0.5 in May, 0.4 in last month. So eating out is still, what can I tell you? Very expensive. So I guess eating at home is, I guess, the less expensive way to go. Of course, nothing new there, right? But costs of eating out have gone up significantly and continue to rise. So when you look at it that way, I mean, there's sort of a lot of numbers at play. Energy really bringing inflation down, shelter keeping it higher, food is kind of a mixed bag. One of the numbers that they look at is, and I'm going back to the high level numbers, they'll break out, they'll look at CPI, but they'll exclude food and energy. And the idea behind that is those are two very volatile categories. So if you do that, if you exclude food and energy for 12 months, we're still at 4.8%. And so that sort of underscores, underscores how much energy has come down. When you exclude that along with food, the 12-month number goes from 3% all the way up to 4.8%, all of which brings us now to the Fed. So the Fed is meeting. We can actually look at their schedule here. They're meeting in a couple of weeks. Here we go, July 25th and 26th. So that'll be the next time, be on the 26th, when we can find out if they're going to raise rates. And then they meet again in September. And the market believes with almost 100% confidence that the Fed will raise rates, short-term rates, in the next meeting by, I assume, 25 basis points. The big question is, will they raise rates again in September? And that's far less certain. Of course, anything could happen even in July. But my assumption is they will raise rates in July, and that in September, we just don't know. And I don't think they know. They're going to continue to look at numbers. But I think the big takeaway is this. Yes, inflation is generally heading in the right direction, but when you get down into the specifics and different numbers, some are going down, some are not going down, like the Fed. I think all of us would like to see. And so until they see that and get inflation under better control, I think they're going to either raise rates. Certainly, I think they will in July. It's my best guess. But also, the other question is, when will they start to lower rates? And I think that's an interesting question. And I don't have the answer. I can't imagine it would be this year, right? They could do a pause like they did last time. So maybe they raise rates in July and pause in September. We'll see. But I think what that means for us, at least for the foreseeable future, is that interest rates generally are going to remain high, at least relative to what they were a year ago. And that's true both for savers, and we're going to look at some specific rates here in a second, but also for borrowers, whether, and particularly mortgages, which is obviously a very important rate for folks, but also for other kinds of debt, including credit card debt. If we look at rates today, let me go back to the screen here. We'll do it this way. I'll leave links to all of this. So this is one of my websites. We track 1,000 bank accounts, something like that. So you can see the highest rates are all above 5%. These are for FDIC insured savings accounts. It also includes NCUA insured credit unions. The top rates are just above 5%. I have not seen them go higher than about 5.15, the highest, but I have seen more and more banks continue to raise their rate up to that level or something close, as you can see here. So there are a number of banks that are at 5% or higher for savings accounts. We see the same thing with money market accounts. Here's one for 5.17, a bunch at 5.15, 5.10, 5.05. And I don't, at least with the Fed probably raising rates in July and certainly not lowering rates, I don't see this changing much. It couldn't possibly edge up a little bit. But I see this, at least for the foreseeable future. If we go to certificates of deposit, of course, this page that I'm showing you, as you can see, has got over 1,000 CDs, but this is of all different terms. But you can see they top out at around 5.5%. And some of these, by the way, are brokered CDs. You can see Fidelity, for example, all the Fidelity CDs listed here are brokered. One thing to note about brokered CDs, the yields can change daily. So whereas a bank's rate on a CD, in theory, of course, they could offer different rates every day, but as a practical matter, they don't. They change it periodically. But with brokered CDs, they change because they're bought and sold, like they're traded like a bond, really. And so the rates change all the time. So just a word of note, we tend to update the brokered CD rates once a week. Otherwise, you'd literally have someone there monitoring it 24/7, changing the rate every couple of minutes or whatever. So just to keep in mind. But so for CDs, 5.5%. And if we go to no penalty CDs, again, similar to savings accounts and money market accounts, just over 5% seem to be where they top out at. And this has been consistent for a couple of months, I would say. We could see, again, I think we might see them inch up a little bit if the Fed raises the rate later this month, but I don't see it being significantly different. Now, the other rates that we're seeing high, and this we're now at the Fidelity website, and I'm specifically want to look at U.S. Treasuries and the T-bills, which would be the 3-month, 6, 9, and 1 years, 1 year bonds. You can see 537, 543, 532, 530, and that's kind of where it's been for a while. It actually makes T-bills an excellent short-term, place to put money, keeping in mind that there are no state and local income tax. So we have a lot of our money that we, for like emergency funds, and we were going to do some work on the house, although now I don't think we are. So I got to figure that out. But that's a whole nother story. But we've had that sort of short-term savings in T-bills just because the rates have been good and there's no state and local income tax. So I kind of see those staying roughly where they are for now. Of course, time will tell. Now, that's all the good news. At least when we compare all these rates to a year ago, they look fantastic, right? And if you think about these rates, they're all well above the 3% CPI, right? I mean, you think about a U.S. Treasury, of course, before taxes, but you're getting a real yield, of about over 2%. Same thing with savings accounts, really, right? Or money market accounts or CDs. So we'll see how long that lasts. But not a bad investment. Now, the bad news is if you're buying a home. So I just picked these rates off of bank rate, but they're telling us the national average is 7.21%. Yuck. Now, this is as of a week ago. So I guess these get updated every Friday. So maybe we'll see an update later today. And you see they've ticked up. I mean, they got to a low. I guess that wasn't very low. I mean, really since April, they've dipped below 7% a little bit, but been above it. Now it's 7.21%. Our daughter bought a home. This would have been 2 years ago, and I'm trying to remember what her interest rate is, but I think it's just over 3%. And boy, with current interest rates, if you've got a mortgage, I know some folks have 30-year fixed rates below 3%. I don't know why you'd ever move, and certainly don't pay off your mortgage early, at least not with current interest rates. At 7.21%, it certainly makes buying a home a heck of a lot more expensive than, say, a year and a half ago. But what's interesting is it doesn't seem to be preventing people from buying homes. I mean, the market for real estate still seems to be very, very strong, certainly in Northern Virginia where we live. I'm told it's very robust. And that really surprises me. I mean, what do I know about the real estate market, right? But you would think when the mortgage rates, double, which is effectively, what they've done, or more than double, depending on what rate you got, you think that would slow folks down. But we seem to be buying homes as quickly as we can. Now, part of that could be supply and demand. It'll be interesting to see how the fact that so many homeowners have a really low interest rate, if that keeps them from moving. Maybe they want to upgrade at some point, but it's like, I can't cash out of a 2.75% 30-year fixed into a 7.2% mortgage. No, thank you. I'm just going to stay put. And that puts a crimp on supply. I don't know. It just seems to me that kind of makes sense. Whether that's actually what's happening, I have no idea. But I do know that the higher mortgage rates don't seem to be reducing folks' demand for housing, and at least not where we live, and not when I've talked to other people that live in different areas of the country. So the other thing that I want to mention before we bring this episode to a close is, how should we think about bond investing? You've got your retirement savings. Maybe you have some of it in bonds. Maybe you're retired. But even if you're not, maybe you have, a 90-10 allocation or an 80-20. I get a lot of emails from folks that say, well, Rob, I mean, given the rates, shouldn't I just put all my bond portfolio, whatever that looks like, into T-bills or even savings accounts, short-term interest rates? And I think that could be a mistake. And I understand the rates look very attractive. And actually, let me just show you this. This is Vanguard's Total Bond Market ETF, and it invests in bonds with an average maturity or duration of around, we'll call it 6 years. We can actually look at it. 6.5 maybe. Yeah, 6.56. Duration is different than maturity, but for our purposes, these are intermediate term bonds. And if you look at the current yield, they call it the SEC yield. It's an annualized number, but it's based on the interest that have been earned over the last, say, 30 days, and then they just annualize it. It's 4.43%. And you look at that and you think, well, wait a minute. Why in the world would I can get a savings account for more than that. I can get a treasury bill and I won't pay state and local income tax that's more than that. Why in the world would I put any money in an intermediate term bond fund, even a great Vanguard fund that's paying 4.43%? It's a great question. And I will tell you that I have a lot of money, I mean, with what I have in this very fund or a comparable fund. And here's the tricky part, is that yes, short-term rates are higher. You can do better right now with a T-bill. But what happens when interest rates go down? Of course, when interest rates start to go down, you would have loved to have been in an intermediate term bond fund paying 4.5%. As rates go down, the value of that bond fund is going to go up. We know that, right? With a T-bill, the yield's just going to go right down. It's going to, or with a savings account, right? The banks are going to adjust the interest rate they're paying you. Yeah, you're making 5.15% a week ago, but interest rates have gone down. So now you're making 4.75. Now you're making 4.25. Now you're making 3.5, and it goes right down. And in that case, you would have been better off, or you would have been happy to be in an intermediate term bond fund. Yes, the yield's going to come down too with the way bond funds work, but that will, at least in the short term, increase the value of the bond fund. And you say, well, wait a minute, Rob, that's fine, but you don't know when interest rates are going to go down. You have no idea, right? Correct, I don't. And that's kind of the point. Chasing yield can, I think, be a very dangerous way to invest your bond portfolio, as tempting as it can be. For example, a lot of folks rushed out of bond funds last year because they performed so poorly, and may have been better off just sticking with them. That's really the point of an intermediate term bond fund. It's saying, I can't predict what interest rates are going to do. I mean, we all might have good guesses. I certainly have my guesses, and I'm right sometimes and really, really wrong other times. And so the idea of an intermediate term bond fund is to say, look, yeah, some years are going to be good, some years not so good. Some years I'd have been better off in a T-bill. Other years I might have been better off in a 30-year long-term bond or long-term bond fund. And that's just the way it goes. If I try to jump to one of those different investments each time the interest rates start to change or move in a different direction, I'm not likely to outperform just sticking to an intermediate term sort of total bond fund approach. So that's what I do. Again, we have short-term money in savings accounts or T-bills, but for our sort of long-term investments to the extent that they're in bonds, we just stick with intermediate term TIPS and intermediate term bond funds like Vanguard's B and D. So that's my take. That's my approach. It's worked for us. I think it's a reasonable approach, but certainly happy to hear your comments. You can leave them below the video. And so that's it. Now, the other big question is a recession. I guess we need to cover that before we bring this to a close. And there's a lot of debate. There's not much debate that we're not in a recession right now. I think most economists agree with that. The question is a recession right around the corner? The crazy thing is the Fed has raised rates significantly. We all seen that. Interest rates have gone up. We had bank issues earlier in the year. Sort of all of these sort of bad signs that would point to a recession. And yet unemployment's just 3.6%. Unemployment is really low, or basically, it's all practical matter. We're at full employment. And that's got, I think, a lot of folks puzzled, certainly myself. I mean, the big concern 6 months ago was, the Fed's going to just push us right into a recession. And that hasn't happened. Now, that doesn't mean it won't happen around the corner. But I think more and more folks are saying, maybe the Fed could pull this off. Maybe they'll get inflation under control without throwing us into a recession, or perhaps maybe only putting us into a mild recession. But it certainly doesn't look like anything can happen, but it doesn't look like it's going to happen this year. I think some folks are sort of predicting, 12 to 18 months out. But of course, at that point, I think my reaction to that is, well, I mean, at some point we're going to have a recession. I mean, the recessions just happen. We have, periods where economy grows, where it shrinks. That's just life. So yeah, I mean, eventually we're going to be in a recession. But I think we've gotten off pretty lucky so far with the economy, with unemployment, and with growth, given not only the significant rise in interest rates, but keep in mind, it's where they started that matters too. They started at zero, basically. And then they've gone up significantly over a relatively short period of time. And somehow our economy has managed all of that really well. I think for me, sort of the bigger concern, longer term, is actually not the next recession. It's government spending has got me concerned. We can't seem to control the annual budget. Deficits are quite high. Our debt keeps growing, and we have all these sort of unfunded liabilities, Social Security and Medicare, two big ones that are going to continue to grow. So that's sort of a bigger, for me, long-term concern. That's another podcast. Well, maybe that's another episode. But right now, recession, maybe next year, I guess. But at that point, it's just, to me, like that's the kind of thing that happens. The economy goes in cycles. So I think overall, pretty good news, unless you're buying a house. And then you got to stick with a mortgage rate that's probably above 7%. Well, I think that's it for today. Give me your thoughts on where we're headed. Do you think the recession is around the corner? What do you think the Fed's going to do? Leave comments below this video. Would love to hear from you. Again, I'll leave links to everything I showed you or talked about both below this video and in the show notes to the podcast. So there you go. Hope you have a great weekend and week. I'll be back with another episode of the podcast a week from today, Lord willing, and the creek don't rise. So until then, remember, the best thing money can buy is financial freedom.